Futures now, let's you can see rebounding just ever so much, adding to yesterday's gain. So let's talk markets now with some stocks to watch. Oh, poor Stephanie.
Yeah, Andrew's happy he's not here.
Yeah, exactly. Stephanie, you go on some of our shows later in the day that are manned by juveniles as well, I think. And you've been on this show a lot. She is a portfolio manager at Hightower Advisors, as well as a CNBC contributor. How are you? Good to see you. Thanks for coming on.
Good to see you. Thanks for having me, Joe.
You've got more data now in terms of corporate reports. You already were feeling, I'd say, what, you feeling like a 6.5 or a 7 about things? It's still pretty good, right?
Yeah. I mean, we've had 66% of the companies have reported earnings, and we're having 82% of them beat on the top line and 68% beat on the bottom line. And you're running at about 8.2% year-over-year growth. So that's pretty good. Now, I'm not pleased with the reactions to the stocks. But we were up about 29% headed into the earnings report. And so you're giving a little bit back, but eventually earnings will matter, Joe. And I do expect volatility for the next 2 months, seasonally not a great time for the markets, especially with Jackson Hole, especially when we have unknowns about what the Fed is going to do. But I do think ultimately the setup into the end of the year will be very positive. And so you want to take advantage of the caterpillars today or the Eatons today. And of course, a lot of the Mag 7 just reported phenomenal numbers, great growth, and you're getting a lot of opportunities there as well.
On Friday, Steph, even though the Fed funds spiked and the prospect of an imminent rate cut got the odds increased, yeah, the market was focused on, I think, growth concerns about those jobs numbers. And we went down on fire. Suddenly, the weekend goes by and we got it all back. What did people do? Did they look at the overall rates, 4.2? If we did get a cut in September at a 4.2 unemployment rate, that's almost like Goldilocks. That's like getting your cake and eating it too, isn't it? Because it doesn't seem like it's anywhere close to recessionary yet.
No, not even close. And I do think we were overdoing it on the non-farm payroll revisions on Friday for sure. First and foremost, by the way, that report is backward looking, Joe. You know that. You look at the weekly jobless claims. That's more of a forward looking indicator. And if you look at the 4-week moving average of weekly jobless claims, you're at 220,000. Now, that is up from 200,000 that we had been seeing about 6 months ago. However, it kind of spiked about a month ago to 245,000. That's when I started to get a little bit nervous. You hit 260, 270, then you're going obviously in the wrong direction. But those numbers have now been coming back down. And I think that's actually what settled the markets, that in the face of all of this, and it's a lot of noise, we are still growing above trend in the economy. You're running at about 2.1% from the Atlanta Fed tracker. And inflation is sticky, but I would take above trend growth and a little bit higher inflation from an equity portfolio management point of view, from an earnings point of view, any day.
And that's not guaranteed because I can't see wage gains in the current environment really getting out of hand. And more of these Fed heads are starting to, it seems like we had another one coming around to the idea that it's a one-shot deal with tariffs, and you might not have the second derivative, where it actually turns into, something that feeds on itself, like, that gets you to 40-year highs like a couple of years ago. It's not that type of inflation, it doesn't seem like.
Well, I think that there's not a lot of people that are talking about the positive impacts of tariffs. Having all of the manufacturing coming here, or not all of it, but a lot more coming here, and that actually is very positive. The onshoring and reshoring that we're talking about, the grid upgrade, all about data centers and AI and that sort of thing. The numbers coming out of the Mag 7 in terms of the CapEx, right? So you've got Google, Microsoft, Meta, and Amazon. They're going to spend $400 billion on AI and CapEx this year alone. That is enormous. That's more than what the EU is paying for all of defense. So that's just to put it in perspective. So there's going to be some positives from the tariffs. I know we're nervous about the inflationary impacts, but the growth should actually be something that we welcome.